Does the thought of a recession scare you? We've recently seen interest rates rise above 5%. At the same time, we're continuing to see housing prices climb. So a lot of people out there believe the next step is a housing crash. In fact, I have many people commenting on my videos talking about how a recession's coming and how that is going to bring housing prices down. So in today's video, I want to spend a little bit of time and actually talk about history, provide you with some data to show you exactly what has happened over time during recessions, what's happened with interest rates, what's happened to home prices. So if you're considering owning a house, or maybe you already own a house and considering selling it because of this doom and gloom mentality that's out there, you can make sensible, informed decisions. Now, I'm often having people comment on my videos saying, hey, Jeb, you're a real estate agent. Of course, you're going to say it's a great time to buy because it benefits you. And the reality is it's not always a great time to buy. In fact, right now is one of those times where you as a home buyer should really consider whether or not it's the right time for you, because we've seen appreciation rise so much over the last couple of years. We're, in the time where a pullback would actually be healthy for the market if we saw a pullback in home prices. Now, I'm not talking a crash because I don't believe a crash is imminent. And in fact, I don't even believe a crash is coming at all. But you do have to be more cautious in the current market because of how elevated home prices are. But I don't want you to be one of the people out there just following the media headlines. In fact, if you were one of those home buyers out there that had been considering buying since, say, 2015, but you were looking at the headlines, Diana Olick on CNBC, this is what she was saying at that time. And let's take a look at what home prices did during that same period. So back in October of 2015, housing today, a bubble larger than 2006. At that time, home prices were about $300,000. But that year, they saw 5.1% appreciation, which took home prices to $315,000. And then you can go through 2016, 17, 18, 19, where she's talking about how housing is bad, it's not a good time to buy. And then in 19, the housing market is about to shift in a bad way for buyers. Appreciation that year, 4%, took that $300,000 home, if you bought in 2015, to $382,000. Then in December of 2019, next year will be hard on the housing market, especially in these big cities. Well, that year we saw 11% appreciation, which took that $300,000 home to $424,000. And then in July of 2021, the housing boom is over as new home sales fall to a pandemic low. Well, that year we only saw 18.8% appreciation, which was another $81,000, taking that home price up to $505,000. Now, that's not even considering the additional part of 2021 and what we've seen so far this year in 2022. So you're looking at probably another 10 to 15% on top of that, which is another $50,000 to $75,000 on top of that home. So you're looking at taking a $300,000 home purchased back in 2015 to around $575,000, $580,000 today if you had purchased that home and not listened to the media. Now, again, this video isn't telling you to go out and buy a house. It is merely telling you don't just pay attention to the headlines. Do what's right for you, your family. If it's the right time for you, you have a longer term time horizon because that's important, then maybe buying a house now could be the best move for you. But everybody has been talking about a recession recently because the 2 and 10-year inverted, that historically has showed that a recession is on the way. Let's start by actually talking about what happens with mortgage rates during recessions. Because we've seen interest rates rise, and it's a hot topic at the moment, I actually want to talk about interest rates first, and then we'll take a look at what home prices have done historically to give you, kind of a bird's eye view of what could happen if history repeats itself, because everyone wants to say history repeats itself. And they're merely talking about 2006, 2007, 2008. That's what everyone wants to reference. But if we're talking about history, let's not just look at one event. Let's look at several events over, a longer period of time to see what traditionally happens during that time. Now, if we're talking about mortgage rates, let's go back to 1980. Now, keep in mind, each one of those blue lines on the screen is when a recession actually occurred. So if you go back to 1980, you can see that we went from a 16% interest rate during that recession to 11.75%. And then in the early 80s, we went from an 18% interest rate down to 13%. And then in the early 90s, we went from 11% to 8.75%. And then in 2002, we went from 7.375 to 6.75%. And then in 2008, the time that everyone wants to talk about, during that recession, we actually went from a 6% interest rate to 4.875%. And then lastly, early 2020, the smallest recession we've ever seen on record, went from 3.75 to 2.75% interest rate. But in addition to interest rates going down during that last recession in early 2020, we saw the Fed come in and buy $120 billion of mortgage-backed securities and bonds, which kept rates super low for a long period of time. Since then, we've seen interest rates start to creep up. The Fed has started to raise the Fed funds rate, which we've already seen a 0.25% hike. And many believe that we're likely to see somewhere between 2.5, 2.75, even 3% by the end of the year, and expecting, 2.5% hikes here over the next couple of months back to back, which is going to bring that Fed funds rate up. So the fear of rising rates is real. But as I just showed you on that chart, historically, once we go into a recession, if that's what you believe is actually going to happen, interest rates should come back down. And part of that is because of this chart I'm going to show you here. Now, this chart here shows the Fed chairman at that time, and we had Burns and Volcker, which was, in the 70s and 80s. At that time, inflation was somewhere between 7 to 14%. Interest rates went from 12% to 18% during that time, but what they did was they started to hike the Fed funds rate. They took it from 11% to 20%. Inflation actually went down, went from 14% to 5%. And at that same time, we saw mortgage rates come down, went from 18% to 12%, as we mentioned earlier. But that put the S&P down 30%, which sent us into a recession. Now comes Alan Greenspan. This is in the 90s. At that time, we had inflation between 1.75% to 3.5%, mortgage rates 7 to 8.5%. The Fed funds rate went from 4.75% to 6.5% in hikes. That brought inflation from 3.5% down to 1%. Mortgage rates also followed and went down from 8.5% to 5.5%. The S&P at that time went down 50%. Which took us into another recession. And then we've got good old Jerome Powell, who's our current Fed chairman. And right now we had inflation from 1.5% to 7.9%. Interest rates went from 2.5% to 5%. The Fed funds rate currently sitting at 0.25%, but they're thinking of taking it somewhere into the 2.5%, 3% range by the end of the year. And historically speaking, inflation should drop, which should bring interest rates down. And right now, a lot of people out there believe that the stock market is overvalued, which, stock prices start to come down, which they already have some. But if they do tumble more, the next step is likely a recession, which takes me into the final chart I want to show you here about housing prices. What actually happens to housing prices during a recession? So if we go back to the 60s, again, each one of these blue lines coming down is a recession. So if you go back to the 60s, you can see that home prices were flat during that recession in the 60s, but they started to creep up slowly after that recession ended. Then we had another recession in the early 70s. Prices climbed a little bit during them and afterwards, and into the next recession, which was just before 75. You can see the trend line is slightly up, but as that recession ends, we can see home prices continue to go up. Into the next recession, which is in early 80 and 82, home prices rise through both of those recessions. And then all the way through the 90s into 2000, during that recession, prices are still climbing. And then we get into 2008. Now, this recession was a little bit different because the recession didn't cause home prices to go down. The housing market is what actually caused the recession. And that was because of risky loans, easy credit, a lot of people owning multiple properties with zero money down on short-term adjustable rate loans, just a really risky credit market. And also at that time, the gap between what it costs to own a property versus what it costs to rent or lease a property was huge. So by letting go of a property, a homeowner could actually go lease something for way less money. In the current housing market, the cost to rent versus the cost to own, there's a very small gap in many markets out there, which means if you do let your house go, you still have to go rent something, and it's not going to be that much less expensive, which means that people are likely to hold on to their properties. In addition to that, the average homeowner at the moment has $185,000 of tappable equity in their property, which means they have a lot of equity. But nevertheless, that was the one recession where home prices actually declined. And again, it's not the recession that caused the home prices decline, it's the housing market as a whole that caused the recession. But in this time, home prices continued down into like 2011, 2012, where we saw home prices continue to rise. And then our last recession here was just in 2020, and we saw the housing market continue to move through that and upwards from there. So the question now is, what happens in the future as we approach another recession? Well, at the moment, we have a super low amount of inventory. While inventory is building in many markets out there, it hasn't changed the dynamic as a whole in many markets. Now, it takes months for this to actually take effect. So as we start to see more inventory come to the market, it's likely to slow housing, but it's not likely to bring prices down significantly. You're likely to see more sideways movement to slightly up movement in markets that have very, very tight inventory. But as I mentioned earlier, if you're considering buying a home now, you just need that longer term time horizon, 5, 7, 10 years. Because the longer you have on your side, the more opportunity you have to withstand any bumps in the road. As I mentioned in another video, home prices have risen on average somewhere around 3 to 5% over the last 40 years. On average, that doesn't mean they've gone up every single year. Some years we've had them go down, but on average, they average somewhere around that 5% number. But over the last couple of years, we've seen home prices rise 18, 20%. Year over year, 35% or so in 2 years. At some point, appreciation is likely to regress back to that trend line of 5%, which means we are likely at some point to have some pullbacks in home prices. But what does that mean? When is it going to happen? It's really hard to say. So if you're a buyer out there, just make sure you're buying for the right reasons, not getting caught up in the FOMO. It's the right time in your life. You have money in the bank. You're not stretching yourself, and you have that longer term time horizon, and you're likely to be sitting in a good spot in the future. But with all of that said, I do have concerns about higher interest rates, which I touch on in this video here. So do me a favor, check that out. Let me know what you think. But for now, I appreciate you taking the time to watch. I appreciate the support. Hope to see you again soon. Have a great day. Bye-bye.